Hey guys, welcome back to another video. So this time around, I'm going to discuss a topic that many of you guys actually talked about, asking me, hey, why do I continue backholding Alibaba? So I think this topic is of particular concern for many fellow Alibaba backholders, myself included of course. And just so you know, it's a change of scenery because I'm currently stuck in school. Back at home, it's quarantine, so yeah, it's a Sunday, 6:40 p.m. here. So if you guys enjoy the effort and enjoy me making content, at least in the NTU context, remember to help me gently tap that cute little like button. But anyway, I think just to circle back into understanding my entire thought process on why I still currently hold Alibaba, maybe just to share with you a little bit of the kind of framework that I actually employ when I look into my current Alibaba investment, and do kind of forgive the background noise because I'm right beside a huge expressway, so let's get right to the topic. So I think when you look into this question or understanding this thought process on you asking other shareholders on why they still hold a particular stock, whether is it Alibaba or any sort of stocks out there that are currently dip in the rate. By dip in the rate, I mean between 20 to 50%. I think you generally get some sort of a similar response because many people keep telling you that hey, the thesis is not broken. Hey, I think that the stock still has a huge upside potential and stuff like that. But I think we all have to acknowledge the fact that we probably actually did enter into the position a little bit too early, which also in translation mean that we probably didn't enter in at a good enough margin of safety. So on that note, I think most of us can admit to that mistake or acknowledge that mistake, which is like why Charlie Munger actually said that he probably entered a little bit too early on into Alibaba specifically. So let me share a few of the conditions that I have in the back of my mind when somebody actually asked me this question specifically. So there are a few conditions that will probably trigger a sale. So firstly, it's of course a fundamental thesis change. If your initial purchase price of a particular company actually did have substantial change or fundamentally change because the revenue might be affected, there is seismic shift in terms of the industry trends, then yes, that warrants a sale of the particular stock or the particular position itself. Secondly, maybe it's because the position has ran up a huge extent in a very short period of time. So that just means that maybe the particular company is overvalued and you're just doing some sort of rebalancing. But more so, if you really look into how we like to construct our portfolio, if you really do hold very high quality companies, sometimes many super investors actually decide to not trim any position. So to give you an example, like what Munger talked about when he was sharing his opinion on Costco. So we all know that Costco is an incredible valuation today. It's trading at like 40 plus times PE. But Munger did say that if you actually do hold for the very, very long term, and if the quality of the business is as it is, and we all know that Costco is a humongous and incredible business, so even if you buy in at a very high enough valuation, sometimes the return on invested capital and how the quality of the company is able to compound over the long term might actually serve as a good for you in the long run. But that said, here comes the issue. We don't really know whether the business is able to maintain and retain its quality over the long term. So in this perspective, sometimes many investors would like to rebalance their portfolio, thinking that, hey, maybe I'll sell a little bit, I start trimming a position, and then I add on to other positions or other conviction. So that's probably the second condition. The third condition is this idea of spotting opportunities elsewhere. So we then introduce this idea of opportunity cost. So I'm not going to spend too much time and I'm not going to belabor the point and what opportunity cost mean. I mean, as investors, we probably all know what it means. But I would just like to caution many investors out there, especially when you think about this idea of opportunity cost. So here comes the issue. When you switch out, actually I do know of many anecdotal stories where many fellow shareholders actually share with me that, hey, I sold out of Alibaba and I bought into X company or Y company. So if you actually sold out of Alibaba and bought into a similar type of company, by similar I mean maybe a large market cap, a company that has a very stable business, it's a high quality business, most of the time people kind of shift their money from Alibaba out into maybe your FANG stocks or some of your big tech or your big franchises like McDonald's, Lowe's, etc. Then I think those are relatively safer and relatively stronger names. So I don't have too much qualms with it. But I think the bigger worry here is when you employ this sort of gambler's fallacy or lose. I would actually talk about this idea of loss chasing. So it's essentially a gambling issue where you lose X amount of money, and then in order to recover the X amount of money, you then go ahead to start taking even more risk because you need to kind of recoup your losses from the initial loss in your Alibaba investment. So from that perspective, I think that's incredibly dangerous. So then some people ask me, hey, what if I rotated my money out from Alibaba into Tesla stock, for example? I think Tesla as a business, it's an incredible business. My only issue is valuations. But if Tesla is able to maintain its market position, if it's able to continue growing revenue, growing other verticals of the business, I think it's generally in the same camp as many of these big tech or even huge, humongous business. The worry is when you start speculating on penny stocks or many of your biotech stocks where they can 2x, 3x easily. I think that's the concern. So when you sell off your Alibaba position, just keep in mind that you shouldn't be loss chasing and you should just be allocating capital effectively and based on the same framework. If you follow a particular set of framework or particular set of condition initially, please try to at least stay within the boundaries rather than just try to speculate out and try to quote unquote make back your money in the shortest period of time. So from that perspective, I think I just wanted to warn many investors on that. And I've seen many actually in my own Discord or people sharing with me their own life story. Saying that how they bought into Alibaba and then when they switch it over, they redeploy their capital and then it continue going down. So are you net better off holding onto Alibaba and just riding it downwards? Or maybe you actually sold out at 100 plus and then redeploy and then that particular stock or the other business actually went down another 50%. I don't know, time will tell. But I'm just saying, from my perspective, I just would like to caution people into falling to this enchantment or this entire idea or concept of opportunity cost, which is extremely dangerous. So now, I think circling back to this idea of whether Alibaba is a good investment or not, I think as investors, you also have to be extremely wary of your thought process when you first enter into Alibaba as a business and start your position. So is it initially a trade or was it an investment? So if it's a trade, for those of you who actually did cut loss because it hits a particular benchmark or if it hits a particular trading condition, then sure, I think that's the right way to think about it. That's the right framework for trading. You should have stop loss in mind. But for those of you who came in as an investment opportunity and not thinking that it's a short-term bet on China, thinking that maybe many of these multiples will actually revert back quickly because of the China reopening, etc., then I think, truth be told, even if I look back into my own investment journey, 1 to 2 years is actually considered a very relatively short time frame. So why not wait a little bit longer? I mean, many of you actually have held the bag together with me for more than a year now. So waiting for another 2 or 3 or 4 quarters, what much difference does it make? And I do understand that the huge amount of volatility around the stock itself, it's extremely tempting to trade in and out. When it hits 120, you draw a few support and resistance line. You sell at 120, you buy back in at 80. It feels very good. But I think I would just like to say that personally, I don't really subscribe to that trading philosophy, but I would think that it works until it doesn't. So that's just my own very rough thoughts on trading versus investing. Now, so at least from an investment perspective, then markets don't seem to really appreciate what Alibaba is currently experiencing, especially with all the COVID reopening, the China reopening story, revenge spending, etc., etc. So I'll go into the details in a subsequent video on why I think Alibaba actually drops to such a large extent in such a short period of time. So do feel free to subscribe and to catch the next video. Now, then begs the question, or back to the entire thesis or the entire idea or concept of this particular video itself. So some of you might ask me, hey Chiking, when are you going to finally admit that you are wrong? So the funny thing is, I actually did admit that I was wrong, I think much earlier than Charlie Munger. I actually did a video much earlier on. I'll leave the link in the description box down below, where I did say that Alibaba was one of my biggest, or I wouldn't employ the same words, but I did say that Alibaba was my mistake much earlier than Charlie Munger, so don't say that I copied him. But I think from an investment perspective, if I were to really employ what Buffett has to say, Buffett has 2 rules for investing, right? The first rule is don't lose money, and the second rule is don't forget rule number 1. So when I lose money, then I'm probably wrong. But at least as of now, most of it is unrealized losses. So unless I click the sell button, then I probably am wrong or I have to admit my mistake. But I think for now, unless the company actually goes bankrupt or if the company gets nationalized, in this case because of all the fears of nationalizing and I don't know what the CCP is going to do. Unless that happens, if not, if the company is still there, if the company is still trading on the stock market, if the company continues buying back shares and the business continues generating profits and free cash flow, then what am I exactly afraid of? This is a question that I still haven't find an answer to that yet. So for those of you who are flaming me in the comment section or people blowing me up on forums, I actually want to ask you guys, why am I exactly wrong? If the company is still there and it's trading fine, it's generating huge amount of free cash flow, and it's buying back shares, why am I wrong? I don't know. So that's that. And I think at least for both scenarios, whether the company going bankrupt or the company getting nationalized, I think those are I would tag a very, very low probability to it. So at least for now, if for those of you who are interested in entering at today's valuation, circling back to Warren Buffett's 2 rules, I honestly don't think that if you hold it for long enough, you're gonna lose money. So if I look at it from that perspective, I don't really think I'm necessarily very, very wrong. Yes, it's a major mistake because I didn't buy at a good enough margin of safety, and now I'm still underwater for at least 2 years of holding the stock now. But back to it, at today's valuation, $80 a share, $100 a share, $120 a share, if you hold for at least 5 to 10 years, I don't necessarily think that you'll lose money. So according to that benchmark and that framework, I don't necessarily admit that it's a major mistake per se. Now, I would then like to throw back the question to people that ask me this particular question on when will I admit my mistake. If I were to reframe it into saying that, hey, let's say Alibaba is trading at $80 today, out into 2030, end of the decade, let's say in 7 years' time, Alibaba is still trading at $80 per share. So from an investment perspective, you didn't make any money. Let's assume that Alibaba didn't give out any dividends. So $80 today, $80 in 2030. 7 years have passed, but let's assume that free cash flow maybe increased by 50%, or maybe even free cash flow doubled. So as of yet, based on my own understanding and just some rough numbers off the top of my head, the current free cash flow yield of Alibaba is around 10%. So let's assume that Alibaba double its free cash flow in 2030. That means that their free cash flow yield would be 20%. So free cash flow yield 20% means that within 5 years, based on the free cash flow that they generate from the business itself, they're able to buy back their own company. And Alibaba still trades at $80. Then from an investment perspective, you as an investor, as a retail investor, sitting on the sidelines, looking at Alibaba with its business metrics, let's say it continues improving its profitability, its free cash flow generation, would you be tempted to buy at $20 billion, at 20% free cash flow yield? I don't know. But I would think that the market is largely congruent and probably largely efficient to understand how they're going to price securities. And yes, you don't have to flame me in the comments. I know that there's this China risk, there's a pricing of political risk, and etc. etc. But that's it. I think there will come a point when people start stepping in. And at least for now, at least from what I read from Wall Street Journal, there is many funds being moving around now. It doesn't look like it's moving because we don't see the stock price increasing. But based on some of the market movements and money flow movements, I think 8.2 billion has entered just this year alone into China's specific equities. So it's true that money is coming in. It's just that it's not really reflected particularly into the stock price itself and the valuations of the businesses. So for fellow investors, I would just say that just remain calm. At least for my patience, it's not really very tested. I don't know about you, but for those of you who are tested, then I think you sign up for something that you probably did not expect in the first place. Now, I think circling back to this idea of profitability, if Alibaba were to really continue improving its profitability, that nobody is stopping them from buying back even more shares. Let's say if it continues trading at a very undervalued price, or just issue a dividend. And when it starts issuing a dividend, then it becomes a dividend stock, and then people have to reprice the security again. So I'm just saying, don't focus too much in terms of the valuations of, oh, what's Alibaba trading today? It's 81, 82, 83, or 60, 59. Focus on the profitability of the business. If the business is able to fend off competition, if they can continue generating a lot of profits, ignore the valuations. The valuations will sooner or later catch up. And there's this classic quote, right? In the short term, the market is a voting machine. In the long term, it's a weighing machine. So try to place more focus in terms of the weight and the value of the business specifically. So that's just all I have to say about valuations particularly. Now, I think to really circle back to the question itself on, hey, when am I going to admit that I'm wrong and why am I continuously back holding Alibaba? I'll just say this as a concluding thought. So my general thesis around Baba still remains intact. The China reopening story, Alibaba being a toll gate business, the cloud computing business, and many of its spawner business, and how it's investing out into Southeast Asia market. Many of the thesis is still running. It's the undercurrent of or underpinning the entire business itself. So, and I still see a huge upside to its current valuation based on the amount of cash that they have and the crazy amount of free cash flow yield that they have on their business itself. So this is your typical quote-unquote value investing, I guess. I don't know how you want to label it. But assuming that they can continue retaining their business market share and also improve their profitability from here. So I do believe that at least in the short term, there is a certain flaw to valuations, meaning that no matter how crazy the risk is, no matter how much narrative people like to build and how much story they like to build around the stock, there is a flaw, meaning at this price point, people will start stepping in. At least based on last year, we know that around $58, $59, that's kind of the flaw. But I don't know whether this time around we will go back down to test the $59, $60 price point again, but there will definitely be a flaw. Sure, Alibaba can trade below net cash. If let's say Alibaba goes down to under $30, because I know that under $30 per share, that's basically the cash position. I don't think Alibaba will get to there, but if it does, then okay. Would you be interested in buying if let's say it's net cash and like it's $30 and you know that at $30 per share, on the balance sheet itself there's more cash than the entire business market value or the enterprise value? I'll leave it up to you to decide. But some people might say that, hey, China risk is too much for me to take on. Sure, that's up to you. But I'm just saying, if it really goes to that point, I'm quite interested to actually accumulate more, even though my entire exposure is humongous right now. But anyway, I think China tech, compared to many of its tech counterparts in the rest of the world, it's much closer to the valuation floor compared to maybe your FANG stocks or even in your European stocks. So that's that. And right now, I'm also not in a rush to essentially redeploy my capital, thinking that, oh, what's the opportunity cost of getting my money stuck in Alibaba? Like I said, I think I shared quite a lot, quite substantially in the previous, in the earlier part of the video on why I'm not so in tune or so enthusiastic about redeploying my capital. It's not all fine and dandy. And also don't forget that many of your assumptions, basically in terms of your assumptions of the business, the quality of the business, the valuation of the business, the intrinsic value and whatnot, those are assumptions over assumptions. So don't be too confident. So don't be too confident that you know what you're doing. And apologies. Last but not least, don't be too caught up into the idea of fear of missing out. If you look at US equities, oh, it's running, China equities is going down. Just follow your own framework. Know what you're investing for. I know a lot of you have your own hurdle rate of 12, 15, 20%. Just follow that framework. Don't be too caught up saying that, oh, this stock suddenly came out to your radar, and let's say Alibaba now has an assumed CAGR of 20%. This new stock comes up 25, 30, 40%. Oh, I start chasing the new stock. I think it's also take time to really understand, to really study the company and study the business as well. So I think those are just my very simple framework. I don't know, I've been ranting quite a lot, but I hope you guys enjoyed how I look into things and sharing my process itself. And of course, remember to help subscribe to see you on the next video as well. So with that, I'll see you on the next video. But more importantly, I'll see you on the moon. Goodbye!